Hello, this is Ryan Mahoney, Associate Advisor at Cypress Asset Management. We are back once more for our quarterly market review, Q1 2023. In the brief presentation to follow, we will look at world capital market performance and a timeline of events marking the quarter. We will begin with a global overview and then feature the returns of stock and bond asset classes in both the U.S. and internationally. We will conclude our report with a quarterly topic. So let's get into it. It was a strong quarter for all of the asset classes that we track, and this might come as some surprise. It was a quiet quarter, I would say, as far as performance goes. The headlines, of course, being dominated by the Silicon Valley Bank run and the subsequent drama unfolding from that event. But as far as returns go, it was, as the numbers show, a relatively strong quarter. We have the U.S. market posting above 7% returns, international at 8%, emerging just under 4%, and global real estate at just above 1%. The bond market as well, both domestically and globally, was also positive for the quarter. So that is very good news. And it's especially welcoming news when we zoom out a bit and look at the one-year returns, which are still negative across the board. The U.S. market still down just shy of 9% for the 1 year. International down just shy of 3%. Emerging markets down close to 11%. Global real estate down over 20% for the 1 year. The bond markets as well down 4 to 5% for the 1 year. So it's been a tough 12 months for investors, regardless of where you've been. Not nearly as bad for the 5 year, and of course, as we zoom out further and further for the 10 year, it's all in greener pastures. Of course, our credo here is simply to stay the course. It certainly would not make any sense to sell, for example, if you have some emerging market exposure, which a lot of our clients do. It's not much, but there is a bit of it there. It wouldn't really be prudent to sell now because, again, you own this fund. You've had it when it has been relatively underperforming. If history be any guide, this should change as investors shy away from certain sectors, certain industries, certain companies that become simply too expensive to own, right? They're going to look for relative value buys in the global market. So this should change with time. Of course, there are no guarantees, but this should change. It looks as if it is starting to swing a bit, but time will, of course, tell. Moving on, we are now looking at the MSCI All Country World Index, plotted alongside certain financial headlines, right? The headlines du jour, if you will, that mark the quarter. We're plotting these against, as I said, the MSCI All Country World Index. And this, I think, is a very good instructor when it comes to putting the headlines and the events of the day in their proper place and their proper perspective as prudent investors with a view to the horizon, right? So as you can see, the big headline of the quarter was, of course, Silicon Valley Bank closed by regulators FDIC takes control. You can see that headline there. Early March looks like where it's marked here, and that, if my memory serves me, that's about when the banking scares were proliferating. And you can see that this headline, which seemed scary at the time, did hardly anything unless you owned a bunch of bank stocks, unless you were concentrated into a bunch of banking stocks, which of course took quite the hit on that day and that week, and they still haven't really recovered. But none of our clients, none of you would have a concentrated position in bank stocks, hopefully. Did not move things at all. I mean, it looks, and that's the point of this slide. This is why Dimensional likes to show this slide in all of their reports. They're trying to demonstrate that, yes, markets move. Yes, the global financial markets fluctuate, but it's not as simple as X occurs in the world or X occurs in the news, and so the market moves as a result. It's much more nuanced and complex, and quite frankly, impossible for any individual retail investor to really know what is causing. We can understand at the macro level, right? When we zoom out and look at periods, we can see, well, what was occurring during this period to cause this, to cause this asset class to do so well, or what was causing, equities to lag behind bonds, etc. We can look at the macro and understand what has caused it. But when we try to pinpoint certain events, especially as they're occurring, so, I'm sure there are probably a handful of investors out there, or more than a handful, that panicked on that day of the Silicon Valley Bank closure, and maybe they sold and missed. Look, I mean, the market, it was somewhat of a rally in the wake of this headline. And again, that opens its own can of worms. Once you're selling, well, when do you get back in? I mean, if it's a matter of waiting for the waves to settle down, it's never going to happen. And that's, again, a good instructor here. You see, it's a weekly, if not a daily basis. There's just something that's coming up that seems alarming, whether it's international disputes militarily, war, conflict, pipelines being destroyed, et cetera, et cetera, et cetera. It is unending. But markets still prevail. Human initiative still prevails. And it is important to always keep one's heart and mind focused on the broader horizons. Here we see the same index charted across the 1 year, and it's the same lesson being shown. Randomness across the board, especially when we look at the headlines of the day in relation to market movements. Getting more specific now, let's look at U.S. stocks and how they performed for the quarter. As mentioned previously, U.S. equity market posted positive returns for the quarter and underperformed non-U.S. developed markets but outperformed emerging markets. More specifically, U.S. value underperformed growth, small caps underperformed large caps, and REIT indices underperformed equity market indices. Now for international. Developed markets outside of the U.S. posted positive returns for the quarter, as mentioned earlier, and outperformed both U.S. and emerging markets. More specifically, international value underperformed international growth, and small caps underperformed large caps. Next up, we have emerging markets. Emerging markets, again, posted positive returns for the quarter although they underperformed both U.S. and non-U.S. developed markets. More specifically, value underperformed growth, and small caps underperformed large caps. Next, we have REITs, or real estate investment trusts. REITs outperformed non-U.S. REITs during the quarter and posted positive returns, just under 3%. Here we see the various global commodities and their performance for the quarter. Again, not going to spend much time on this slide because we do not deal in commodities for any of our clients. And lastly, fixed income for the quarter. Now, like U.S. equities and global equities, fixed income, both domestically and globally, posted positive returns for the quarter, though still down for the 1 year. Now let's briefly discuss the current interest rate environment as the Fed continues to slowly, gradually raise interest rates. We are still seeing an inverted yield curve, and you can see quite well that shorter-term bonds yielding more than their longer-term counterparts, making for an inverted yield curve. This is usually not the case. Usually, when the curve is not inverted, when the curve is considered normal, you would see longer-term bonds paying higher yields than shorter-term bonds. More specifically, we see that on the shorter end of the yield curve, the 1-month T-bill increased its yield by 62 basis points to 4.74%, just shy of 5%, while the 1-year T-bill decreased its yield 9 basis points to 4.64%. So you see a 1-month T-bill offering a greater yield than a 1-year T-bill. The yield on the 2-year Treasury note also decreased 35 basis points to just over 4%. So that's a steady decrease there from the 1 month to the 2-year in the yields that they're offering. Now the yield on the 5-year Treasury note decreased as well, 39 basis points to 3.6%. The yield on the 10-year Treasury note decreased 40 basis points to 3.48%. So we see still a decrease. We're seeing it, the inverted yield curve play out here. And the yield on the 30-year Treasury bond decreased 30 basis points to 3.67%. That's quite the spread there. You're getting more on a 1-month T-bill than a 30-year Treasury bond. It's quite interesting. Zooming out now to global fixed income, and we see a similar trend. Inverted yield curves in much of the developed world. I'll conclude with a brief article penned by Dimensional Fund Advisors. They put these out every quarter to sort of wrap up the quarter and offer a takeaway as we enter Q2. I'm not going to read the article, but I will leave it up here if anyone would like to read it. The takeaway, of course, being exactly what we have already discussed previously, that uncertainty is unavoidable, that market timing is futile, and that diversification is your friend. Of course, they're all related because the world is so vast today. It's inevitable that we're always going to be witnessing some tragedy, some catastrophe, some form of conflict occurring somewhere in the world on a pretty regular basis. It would be stranger if these things didn't occur for an extended period of time. That being said, it's not useful and, in fact, futile to try and weigh these events as they are occurring when it comes to making prudent investment decisions. We as we saw on the previous slides, the market does move, but it doesn't move because of X or Y occurring. The markets are forward-looking. We are simply doing ourselves a disservice when we start trying to act and time our decisions based on what we are hearing and seeing in the news. And if anyone doubts that claim, just simply revert back to those two slides with the MSCI Global Index, and you cannot see, there's no apparent correlation there between the biggest headlines of the day and significant trends, either positive or negative, in the global markets. Now, this being the case, we conclude with point 3 here in the article. Diversification is your buddy. And that's simply because diversification is going to help you weather the storm of uncertainty. It is, of course, a truism and foolish to put your eggs in one basket, especially when we live in an uncertain world. And so we diversify. And we diversify in a way that is strategic by controlling our costs. And that is why we so often use Dimensional, and they mention it here in their article. That is what has made Dimensional the institutional powerhouse that they are today. They obsess over cost because they know they can control costs, and they also know that if they can save a few pennies here, a few pennies there on their block trades that they're doing for their clients like ourselves, those small, seemingly tiny gains add up exponentially and tremendously over decades. And that is why their funds historically are so impressive. So with that, we will conclude our Q1 2023 perspective. I hope this presentation was of some use to you, and I look forward to seeing you again in Q2. Take care.